audible.
Yes, ma'am. All good. So I'm starting with your class now, and this is your strategies class. That is, we are going to discuss the strategies for equities. That is for intraday in this class. We will be discussing the basic strategies. Basic means I'm going to tell you the basic entry, the basic exit, your risk, your reward. Everything I will be telling you in this class. Whereas the strategies are not completed in this class, that is, we are going to complete the strategies in the next class, which is your upcoming class, which is going to be your third class. And in this class, we are just discussing the basic entries, the basic exit, your risk, your reward, everything I will be teaching you. And in the next class, I will be teaching you how to remove the false signals. False signals means the false entry or the false signals which you get in the market. There are so many false signals. So I will be teaching you that in the next class. I will be teaching you how to select the stocks in the next class. The accuracy depends on stock selection basically. So right now we are just understanding the entries, the exits, and your stop loss and your risk and your reward. So I'm starting with this part, that is the third PDF. If you remember, technical analysis part 2, which is the candlestick patterns, this was left. So I'm starting from here only, then we are moving ahead with the strategies. So first of all, candlestick patterns are basically the reversal patterns. Reversal pattern means whenever or wherever any of these patterns, appear, or in case you identify any of the candlestick pattern anywhere in any trend, that means that is a sign of reversal, which means that particular trend, that particular stock may reverse from there, can reverse from there. That is not a compulsion that it will reverse, but it may reverse, it can reverse. So for a safe side, we will be exiting the open trade, that is the open position. In case you have taken a trade, in case you have entered into any position, entered into any trade, we will be exiting from that, which means we are using these patterns for the exit and not for the entries. This is your first point. So starting with the first reversal pattern, you can see this is the first reversal pattern, which is known as the bullish engulfing pattern, which is very easy. Bullish engulfing pattern means if a big green candle covers or engulfs a small red candle, that is known as the bullish engulfing pattern, after which the stock is going to behave in a bullish way for the next few candles. For how many candles we can't state that, but just for the next few candles it is going to behave in a bullish way. And just now I told you these are reversal patterns, which means after reversing it is behaving in a bullish way, which means previously it was bearish. So what you have to remember is, if in a downtrend, if in a bearish trend where you must have sold the stock, this must have been a selling trade. So in your selling trade in a downtrend, if you find a big green candle which has covered or which has engulfed a small red candle, that is a sign of reversal, which is the bullish engulfing pattern, after which the stock may reverse. So you will be exiting from your trade. I can show you an example for this. You can see here. You can see the example for bullish engulfing pattern. You can see the stock was behaving in a bearish way. It was declining. So when the stock is declining, we will be selling the stock here. So in your selling trade, if you find a big green candle which has covered or which has engulfed a small red candle, that is a sign of reversal, which is the bullish engulfing pattern. After which you can clearly see the stock has reversed from its previous trend, which means we will be exiting the selling trade here with whatever profit you have already booked, without any profit, or with a small profit or with a small loss. So this is your first reversal pattern. And the opposite of this is the bearish engulfing pattern, which you can see here. Bearish engulfing pattern means if a big red candle covers or engulfs a small green candle, that is known as the bearish engulfing pattern, after which the stock is going to behave in a bearish way for the next few candles. Again, the same thing, after reversing, it is behaving in a bearish way, which means previously it was bullish. So what you have to remember is, if in a bullish trend, if in an uptrend where you must have bought the stock, this must have been a buying trade. So in a buying trade, if you find a big red candle which has covered or which has engulfed a small green candle, that is a sign of reversal, which is known as the bearish engulfing pattern, after which the stock is going to reverse. So you are supposed to exit from the trade. So these are the first two reversal patterns. Any doubts with the first two? Hope they are clear.
Ma'am, just 1 minute. You said that previously when it is a downtrend, we have to exit the market when we spot that trend. Why, ma'am? It is going to be going upward only, right?
So we sold the
Then,
stock there. We didn't buy the stock. That was a selling trade. If you remember short selling, which I explained you in the
oh,
technical
okay.
analysis pattern.
Yeah. Yes, yes. Okay, okay, okay.
See,
Got it.
the stock
So
is
if we are short,
declining. Anything
right?
which is declining, you won't be buying it, right? We will be selling it. So this is a selling
Okay.
trade. The entry was for selling. So now we know that the
Okay.
stock is now going to reverse from the selling trade, which was a declining trend. So we will be exiting from the selling trade here.
Okay, okay,
And we are
okay.
not
Got it.
entering because we can't calculate for how many candles this is going to behave in a bullish way. So no new entry. No entries
Okay.
using these patterns, just the exits.
Okay, okay. Got it. Thank you.
So the next one, which is the hammer, you can see this is the hammer, and you can see this is what a hammer looks like. You can see the candle's body will be at the high, and beneath it we will be having a long shadow, which is a compulsion. That is, for a hammer to be formed, this is a, you can say this is kind of a condition that we are requiring long shadows. Only if the shadow is long or big in size, then only it is a hammer. If the shadow is not big in size, that is a normal candle. So again, hammers are very effective signs of reversal. You can see here. You can see the stock was moving in a downtrend. A hammer is formed, after which it has reversed. So as soon as a hammer is formed and closed, that is your exit. And we are having two types of hammers. You can see the first one, if a hammer is formed in a downtrend, it will be formed in green color, after which the stock is going to reverse. And if a hammer is formed in an uptrend, it will be formed in red color, which is also known as hanging man, after which the stock is going to reverse. And the last one, which is known as a dozy, you can see this is what a dozy looks like. It is a plus sign shadow without any candle's body. That is, in a dozy, we are not having the candle's body. This is a proper dozy. So in a proper dozy, we are not having the candle's body. That is because the open price and the closing price of the stock is the same. That is, if the stock is opening at around rupees 100, it is closing at 100 only, then only it is a proper dozy. And these are also very effective signs of reversal. You can see here. You can see the stock was moving in a downtrend. A dozy is formed, after which the stock has reversed. So this dozy was your exit. And here you can see the dozy, which you can see. This is not a proper dozy because we can clearly see a candle's body here, which indicates that there must be a slight difference in between the open price and the closing price. So this is not a proper dozy, but we are going to consider shadows, or you can say candles like these, as dozies only, because shadows like these means any shadow which is too big in size with a comparatively very small candle's body. For example, you can see the second candle from the top is also a dozy. Then you can see the last green candle is also a dozy. So any candle which is having a big shadow with a comparatively small candle's body, that is a sign of reversal only, that is a dozy only. The stock is going to reverse from there. Such shadows are only formed when there is a possibility of reversal, or you can say there is pressure from the opposite side. Opposite side means here you can see the stock was bearish. So if we are getting buying pressure, this kind of shadow is going to be formed. If in a bullish trend we are finding this kind of dozy, that is a selling pressure which is going to start. So also we are going to treat such shadows as dozies only. These are also the safe exits. Any doubts with the three reversal patterns? Any doubts, anyone? I hope it's clear. Okay, so I'm starting with your strategies. Again, I'm mentioning some of the things very quickly. The first thing is these are just the strategies which you will be using in intraday. Just we are using these techniques in intraday. For all the other segments, we are having different methods, we are having different techniques. This is the first thing. Secondly, the strategies will be completed in the upcoming class. So right now we are just discussing the basic things. Thirdly, if you remember in technical analysis, I mentioned that intraday means when we are closing the trades within the same day, on the same day, or you can say intraday means when we are capturing fast movements or small movements. So for defining your entries, defining means for finding out your entries, we will be using the 1 minute time frame. That is for finding out your entry, for finding out your exit. In intraday you will be using the 1 minute time frame, whereas we will be using a higher time frame as well, which I will be teaching you in the next class, which will be used to remove the false signals, or you can say to for the confirmation, that is if that particular trend is having strength or not, if that particular entry is correct or not. For that we are going to use a higher time frame. Right now we are just using the 1 minute time frame for finding out your entries as well as your exits. This is your first point in strategies. Secondly, also another thing I mentioned in technical analysis, which was using technical analysis, using price action, you can define your entries, you can find out the entries, but you can't calculate the target, you can't calculate your risk, you don't know the exit. So that is the reason we are going to use some indicators, so that at least we can calculate a minimum profit, we can book the maximum profit, and we can calculate the risk. So for that we will be using some indicators, and the first one is known as a moving average, which is a very common indicator and a very simple indicator. So moving averages basically tell you about the trend, the average trend of the stock for whatever time period you set up here. So the first moving average which we are going to use will be having a period of 13 days. Field will be close, type will be exponential, and you can denote this with any color. Here you can see I'm denoting this with red color. So here you can see this is your first indicator, which is a 13-day exponential moving average, which is denoted in red color, which is telling you about the trend of the stock. Trend of the stock means the direction of the stock. Here you can see the stock is bullish, so the average is also behaving in a bullish way. It is moving along with the direction of the stock. Then comes the second indicator, which is again a moving average. with a period of 50 days. This time field is again closed, type is again exponential, denoting this with a different color so that you can distinguish between the two of them. So here you can see this is your second indicator, which is a 50-day exponential moving average, which I have denoted in white color. And this we are using just for confirming the trend, the direction of the trend, or just for confirmations. Confirmation means, here you can see, if you remember, I told you the red one is telling you about the direction of the stock, but we needed a point from where we could analyze that from here the market is reversing or the stock is changing from its previous trend, or it is likely to give you a new trend. So basically we are going to work on the intersections of these two. And the third indicator, which is going to be your stop loss, which is known as the ATR trailing stops. For that you will be using the default settings. That is, here you can see I've just applied it. With the default settings I have changed nothing. So no changes to be made, only the default settings we are using. These are the three simple indicators which we are going to use, and we will be increasing the accuracy using a filter, using stock selection, and using these three indicators. So I've just applied them. Kindly focus right now. You can understand only, no need to write anything. I will be sharing this class with you. So just focus on understanding. I have applied the indicators. I'm starting with some basics of these indicators. I'm starting with the basics because, you know, when you are using any thing, or you can say when you are using any new tool or any new indicator, you must be aware with its basics first of all. Then only we will be starting with the strategies. So the first basic of using these moving averages is whenever these moving averages intersect, or you can say whenever these moving averages cross, that means the stock is changing the previous trend, reversing from its previous trend, or giving you a new trend. Or in simple language, you can say if the red line crosses the white line and moves in the upward direction, or you can say when the red line is moving above the white line, that means the stock is bullish. When the stock is bullish, that means the stock price is going to increase. Now the stock price is bullish or the stock price is going to increase. So in this scenario, you will be always buying the stock. You're never supposed to sell it. This is your first basic. That is, when the red line is moving above the white line, always buy the stock. This is a buying trade, never sell it. And the opposite of this, which is when the red line crosses the white line and moves in a downward direction, that means the stock is bearish. It is going to decline now. Now the stock price is going to decline, so we won't be buying it. So this is a selling trade. So again, in simple language, if the red line is moving below the white line, you are always supposed to sell the stock, never buy it here. This is your first basic. The second basic, again I'm saying this is intraday. Intraday means when we are capturing movements, which means for booking the profit, you need a movement in the first place. So this is your second basic, that is always trade when the stock is giving you a movement. That is, you know, in intraday you will be only booking profit in two scenarios. The first scenario is if you are trading in a continuous uptrend, that is if you buy the stock and the stock price keeps on increasing, or you are trading in a continuous downtrend, that is in case you sell the stock and the stock price keeps on declining. These are the only two scenarios which are going to give you a profit, and just a single case in which you will be booking a loss, which is when you are entering in a consolidation. Consolidation means, if you remember, I told this to you in the technical analysis class also, when the stock is in a consolidation, that is when the stock is stuck in a particular space. It is not having any levels. That is not a continuous trend. That is known as a Consolidation. So this is your second basic, that is never trade when the stock is in a consolidation. Always find a continuous uptrend or a continuous downtrend, and this will be done using the stock selection, using your filter. That is, using the stock selection, we will be choosing the stocks which will be giving you a continuous uptrend or a continuous downtrend at that particular time. Then comes the third basic, which is the most important basic. So the third basic is, whenever you are making the entries or whenever you are finding out the entries, you are always supposed to enter on a candle which is safe. Safe candle means any candle which is small in size, which is not too big in size, not having a big shadow. Every such candle is a safe candle. So whether you are buying the stock or you are selling the stock, you will be entering on the candles which are small in size, which are not too big in size, not having big shadows, the candles which are safe candles. This is because this red line is your mean average line, which means it is playing the role of center of the stock, which means whenever you are entering on any candle which is small in size, which is not too big in size, which is not having a big shadow, which is a safe candle, it is by default nearer to the red line. So when the candle is already nearer to the red line, it is only having a single option, which is to move away from it. And when the candles are moving away from it, the trade is always moving in our direction. Our direction means if we are buying the stock, the trade is moving in our direction, which is the bullish direction. And if we are selling the stock, the trade is moving in our direction, which is the bearish direction, which means the stock price is declining. Whereas if you enter on a candle which is not small in size, which is an unsafe candle, which is too big in size, having a big shadow, here you can see an example. So what happens is it moves away from the red line. So it is only having a single option, which is to move back to the red line. So the trade always moves in the opposite direction. The trade always reverses. So this is a very important rule, that is always enter on a small and safe candle, which is small in size, not too big in size, not having a big shadow. And right now, if I'm marking any candle as your entry, that is, suppose I'm marking this candle as your entry, that means once this candle is formed and closed, after this, the stock has given you the entry signal. After that, you can enter, because we are understanding the things on the past chart. So this is what I mean when I'm marking any candle. So once this candle is formed and closed, that is a confirmation. That is, once you find a small and safe candle, that is a confirmation that the stock has given you the entry, after which you can enter. On which candle you are actually entering, that is never in your hands, that is impossible. So these are the first three basics. Anybody else facing sound issues or audio issues? I hope the audio is clear. Any doubts with the first three basics? I've just explained you the basics.
Hi, actually, I have a small doubt. So for the entry, we will use the smaller candle, correct?
For entry, yes.
Yes. So in this graph also, I can see some candle which is away, small candle which is away from the red line also, and which is closer
No,
to
we
the
are
red.
not judging, you know, any small candle which is small in size. It is by default nearer to the red line. We are not judging this, through our eyes. This is
Uh,
just a technical rule. because when the market is the live market, in the live market these moving averages are formed after the candles are formed. So first the candles are going to form. So there's only a single way, which is to judge the candle if the candle is safe through its size. So that is the reason I'm saying any candle which is small and safe in size, or you can say any candle which is small in size, not big in size, not having a big shadow, that is a small candle. So any candle which you are watching right now, which you think is away from the red line, you can see is going to reverse for one or two candles only, then continue. Whereas the unsafe candles which I'm mentioning, they are reversing very badly.
Okay.
So in these cases, your stop loss may hit, or you may exit a profitable trade in fear. So that is the reason this is also a psychological rule.
Okay. Understood.
Any other doubt, anyone? So the basics are clear. Yes. Any doubts?
So, ma'am, any candle that is closer to the uh, red line is considered safe?
Small in size, ma'am, not
Small.
closer to the red line. Any candle which is small in size, it is by default closer to the red line. So we are judging using
Okay.
the size. So any candle which is small in size, not big in size, not having a big shadow, it is safe.
Okay. Okay, ma'am.
Shraddha, if you don't mind, can you repeat all these three rules in a single sentence? Just a simple three sentence.
So do not write, first of all, I'm
Yeah.
repeating this. So I will
Okay.
be sharing the class with you. Yes, I'm repeating them in a single sentence. So the first rule was, if the red line is moving above the white line, you will be buying the stock. If the red line is moving below the white line, you will be selling the stock. Second one was, you won't be entering into a consolidation. You will be finding out a trend to enter. Third one was, you will be finding out a safe and small candle to enter. These are the three basics, and I'm
Okay.
starting with the strategies now. And I'm starting with the first one, which is your first strategy, which is known as the mean average strategy. So mean average you will be using from you can say 10 a.m., that is 10 in the morning, to 3:30 p.m. That is the time period to use the first strategy, and that is very easy. For understanding that, you just need to focus on the screenshot which you are watching on your screen. We are going to observe some things here. So here you can see first thing which you will be observing. If you remember, I clearly told you do not trade when the stock is in a consolidation. So this is a no trade zone. The second thing which you are going to observe here is, you can see the red line is moving above the white line, which means this is a buying trade. We are supposed to buy the stock here. The third thing which you are supposed to observe here is, you can see here at 1:15 the stock made the first high, then you can see this high was made, then this high was made. And again, if you go back to the technical analysis, I told you all the highs are behaving as resistances. So what I'm trying to say is, your buying entry in a buying trade will be wherever all the previous highs, the highs which are behaving as resistances of your previous consolidation, are broken, and a small and safe green candle is formed and closed. That is your buying entry. I can give you an example for this. That is here, you can see. You can see here, first of all, you can see here, you can see the red line is moving above the white line. So this is a buying trade. Secondly, if you notice, we are having multiple highs here. This is the high which we are having. This is one high. Then this high we are having. Also this one. So I will be considering the highest one. so that all the other highs are included. So your buying entry in a buying trade is wherever all the previous highs are broken, which you can see are broken by this green candle, and a small and safe green candle is formed and closed. That is your buying entry in a buying trade. And similarly, in a selling trade, here you can see a clear selling trade, that is the red line is moving below the white line, so we are supposed to sell the stock here. So your selling entry in a selling trade will be wherever all the previous lows, the lows which are behaving as support, are broken, and a small and safe red candle is formed and closed. That is your selling entry. So these are the simple entries using your first strategy, which is the mean average strategy. Any doubts with the entry part? Any doubts?
Okay, what? Uh,
Yes.
so, the one which we told the last for the safe and entry, this is for the consolidation, right? Which you said.
Sorry,
Can you hear me now? Hello.
I'm not getting your question. I can hear you very clearly.
So the one which we told right now for the for
The
for
second
the
entry
highest,
is for the selling entry, the shorting trade.
yeah, short-term trend. So this
Yes.
is for the consolidation trend.
Both of them are for, so this that is a rule. In the buying trade, your entry will be wherever all the previous highs of your previous consolidation are broken and a small and safe green candle is formed and closed. And in the selling trade, wherever all the previous lows of your previous consolidation are broken and a small and safe red candle is formed and closed. Consolidation is going to be everywhere, every day, before every trend.
Understood. So based on this consolidation, based on checking the previous trends, we can draw the line. Then once it is cleared and make a small, for example, if you're buying a small and say green candle is up, then we
Yes,
can understand that the consolidation is over and is going for uptrend,
yes,
correct? Okay, the same for the downtrend also.
yes.
Okay, cool. Thanks.
Any other doubt, anyone? Okay, so right now you will be re-logging in. That is, kindly re-log in using the same link and the same password. I am continuing the very next part, which is your minimum profit. That is how to book a minimum profit. So kindly re-log in. Please allow your audios as soon as possible.